Barclays out with a note on Nike, reiterating its overweight rating on the stock and price target for the retailer. Now, the analyst behind that call, Adrienne, naming Nike its best idea for 2024. And this call coming as Nike has really failed to regain some of its momentum over the last several months since the start of the year. The stock off just about 7% over the last year. We're looking at declines of just over 20%. It's also falling another 1% today. We want to bring in Adrienne, Barclays Consumer Discretionary Senior Analyst, to discuss more. And Adrienne, when you take a look at this name, you're still bullish about what Nike maybe is going to prove in 2024. What are the catalysts ahead for this stock?
So the catalysts are really, number one, that they absolutely have their inventory. So the supply side of things is inarguably fixed. And so that's half the battle, right? So they want to get to a pull market where their wholesale channel partners are ordering, replenishing, restocking from them. And that's a guaranteed sort of plus to the revenue. We don't think that's happening in the first half of the year at all. We already know that all the retailers are still buying down and very conservative, but you have to have a replenishment cycle of newness. And that's where the innovation comes in. The catalysts are a whole slew of innovations coming for this year, the likes of which we haven't seen in 2 years. And I can go through those in a second, but that's really the two catalysts. Innovation to drive top line, supply is tight.
Adrienne, when you mention innovation, I was just reading in recently on that new Air Max DN, that platform particularly, and it really seems interesting where for a shoe company that's had so much success with the retros, that gets everybody clicking, that gets people going on to a sneakers app and crashing the dang thing all the time, where they're balancing innovation and need to balance innovation with what people have just flocked to in the past. And so what is the correct way that investors should be grading the company on how they execute that?
They should be grading the company on what is new and the incremental unit newness. So what's going to get the consumer to spend, the dollars on a new pair of shoes. I can appreciate the retro, side of things, but that's been the problem with Adidas, with Vans, and with Nike. They're selling the same things over and over, and it's getting, quite frankly, kind of boring. They sort of missed out on what I call the soul wars, like On, Hoka, these high-profile platforms. The Air Max DN is coming in March, on Air Max Day, March 26th, mark your calendars. Right after that, they're going to have the Peg 41, the Pegasus 41, which is a whole new form factor. So that's brand new. And then they're going to follow with Copa America in June, and then the Paris Olympics. All this is newness and innovation. And what I'll say is, when you have the newness, people don't immediately buy, but this is the first time we've seen kind of the leadership, right, led new by Heidi O'Neill, that is just focused on speed, hustle at scale.
Adrienne, what do you think the margin recovery story looks like? And more specifically, you and I have talked so much just about the inventory levels with Nike. There has certainly been a lot of improvement over the last several quarters, but where do you think they stand as we look out towards year end in terms of that continued improvement that many analysts have been calling for?
So fiscal year end for them is May. And this is a pretty anemic, they just lowered guidance. Plus 1% top line sales. Consensus is looking for a 12.3% operating margin. That's below the 10-year average of 13%. Right. So this is, so what we always say is they just got their inventory clean sort of at the end of July, clearly at the end of November. It takes about 2 quarters for it to percolate into the system and run through the income statement and the margins. So we're seeing, kind of the back half of this calendar year, but certainly for FY25, 150 to 200 basis points coming just from cleaning up the inventory, not, spending money on storage, losses and damages. Just all those kind of ghost inefficiencies and all the friction that comes with just being supply chain and inventory inefficient. And so we haven't even put in the top line recovery. If we want to talk about top line recovery over the course of 25, 26, 27, we think there's probably 400 basis points, right? 200 in the near term from below the top line, another 200 basis points from leverage. So 12%, 13%, high teen margins over the next 2 to 3 years.
Adrienne, while we have you, one of our producers brilliantly wrote up last week that City Boys are up as Lululemon is coming out with their new men's shoes here. We think across the Cityverse, the casual shoe, of course, that is set to start things off, plus the performance styles. What does a successful entry into that performance and just overall footwear market in men's look like for Lulu from your perspective?
So Lulu is, as you said, very newly launching. It's gotten, good kind of PR on websites, et cetera. We're really excited for this piece of the business. But just remember, for Lulu, men's and women's, the entire footwear is a low, like 2% of their 5-year plan. Right. So I love Lulu because they take these big risks, but then they don't put the execution is not a big risk on the P&L. We're very hopeful that it completes sort of that whole head to toe outfitting. It opens new TAM categories. Lulu is just excellent and has been excellent at kind of keeping that innovation pipeline. And remember, the launch of the shoe is a 5-year investment for them. So through and through the pandemic, they never let up on that product design and development. And so they're winning.
Adrienne, I feel like you and I could have a really good sneaker podcast one day. I'm just going to throw that out there. Do with that with what you will. But at the end of the day here for Lulu, I mean, this really kind of in the category itself, the contribution, what should investors expect for how early this can be a contributor to the company and the broader pillars that they've laid out?
So, if we think about apparel companies that have entered footwear, right, it's tough, right? Footwear kind of going to apparel, you kind of have that brand out there, but Lulu already has that brand. If we think about long term, right? So it would not be unusual to think about 60%, 2/3 of the business coming from their core apparel and 25% over time kind of coming from this footwear and accessories piece of the business. That's obviously a long time away. But the fact of the matter is when you have such a strong brand and then you platform that onto footwear is the kind of completer, particularly with men. I always like to say this, boys and men like to dress from the feet up, right? You spend a lot of money down on your feet and then, I don't know, kind of not a lot everywhere else.
Look, you're not lying. I feel personally attacked almost, or just really seen right now. Adrienne Yee, Barclays Consumer Discretionary Senior Analyst. Thanks so much for joining us here today. Always a pleasure.
Great to see you.
See ya.